Good evening, everybody. My name is Nathan Jones. Today I'm going to be presenting to you all about how an IUL, this is literally a cheat code in the financial services industry. I'm going to explain a multitude of ways, but I'm going to go into detail about the history of it, what it actually is, what you need to know, and how it could potentially help you become financially free. So without further ado, let's get started. So what is an IUL? An IUL is a personal life insurance policy. It's flexible premium permanent life insurance. It's got two key components, a death benefit and a cash value that grows tax deferred over time with the stock market, but with security. The way that it works is you use what's called the indexing strategy. It has two things, a cap and a floor. The cap meaning you have a max amount of interest rate you gain, and a floor, which is typically 0%, meaning you're never going to lose principal. As this presentation continues, I'll further explain how that actually works. And the great thing about it is that it has flexibility. You get to decide how this is structured. Now, as far as history goes, the first IUL launched in January of 1997. I was 7 years old then, believe it or not. This was then introduced as the Transdex 500 by Transamerica Occidental. They are just called Transamerica now. In 2000, Transamerica left the IUL market along with 10 other carriers. Then, 7 years later, it re-entered the market with a new design called the Transindex IUL. The sales from 97 to 98 was about $68 million in premium. And then the sales from 2007 to 2012 went from about $1.3 billion. That's a pretty crazy jump from something that left the market 10 years ago. And then about 10 years later, it produces the numbers that it produced. Pretty impressive. And at the end of 2012, 50 carriers were offering an IUL. Now, what do you need to know? You need to know your age, your health, and your lifestyle. If you're young and healthy, you're going to get better terms, and it's going to be much more affordable for you to do something like this. But if you're older with more health concerns, it's a possibility, but it depends on how much of the risk it is. All underwriting is just a risk assessment. That's all it is. If you're at a high risk, that's going to decrease your chance of you getting a policy like this. Whereas if you're at a low risk, that'll definitely increase your chances. Now, first off, the policy has to match your financial needs. If you're retiring, I would prioritize the cash value. If you're protecting your family, I would prioritize the death benefit. Or if you want to prioritize both, that is something you can absolutely do. So this is how an IUL works. This is also called this version of this particular one is called the tax efficient savings strategy. Us as a broker group call it the life insurance retirement strategy. So as you can see here, hypothetically, let's say we have a $200,000 death benefit. The cost of insurance is $40, but your monthly premium, we're going to add an additional $460. And that $460, that's going to go into your cash value. So that'll bring your total premium to $500 a month. And for that first year, let's say your cap is 13%, your floor is 0%. Let's say for that first year, your market gained 10%. Typically, the stock market index is going to be used is the S&P 500. For those of you who don't know what the S&P 500 is, it's the stock market index of the 500 largest companies in the United States. So think of the companies like Apple, Google, Walmart, all those really big companies in one particular stock market index. So let's say you gain 10%, your cap is 13%. So that means you keep your 10% and you keep your gain. If the market crashes that one year, so if you see here, if that market crashed 12%, notice because the indexing strategy, it's still at 0%. Same thing, market goes up 15%, but since your cap is 13%, you get your 13%. But if the market crashed 20%, because of the indexing strategy, you're never going to lose principal. And as your savings builds up over time, your cash value will be able to be 100% tax free, meaning Uncle Sam cannot touch your money when you start taking out your money. And I'll explain that shortly. So the tax benefits, three IRS codes I want you to keep in mind. IRS code 101A, which gives you a tax-free death benefit check. IRS code 72E, which gives you tax deferred growth, as opposed to something like a 401k, because this is a life insurance policy, that bleeds into IRS code 7702, which governs life insurance contracts. In the government's eyes, they see life insurance as a bill. And last time I checked, your bills do not get taxed. Not your water bill, not your gas bill, not your, you know, your subscriptions or anything like that. Your bills do not get taxed. And because your bills do not get taxed, that is why this particular asset is able to grow tax deferred. And Uncle Sam cannot touch your money when the money's taken out because it's a tax deferred account, meaning the money goes in pre-taxed, the money grows pre-tax, but typically we take out that money becomes taxable. But with an IUL, that's why it's not going to be taxed. And this allows you to get tax-free access to your cash value without triggering taxes via policy loans or withdrawals up to basis. All withdrawals up to basis means is that you cannot take out more than what you put in until your IUL reaches its full potential. So meaning, if you're trying to take out more than what you put in, that's when it's going to endure what's called a surrender charge, and that's more and we'll start to cover that very shortly as well. And you can use these policy loans to create tax-free income in your retirement. So more tax benefits. This must be structured below what's called the MEC limit. MEC is the acronym for Modified Endowment Contract. This means that you'll overfund it beyond IRS limits. It's very important that you do not overfund it past this level, because if you do, that's where your life insurance policy will become taxable and your loans become taxable. And if you mention the word modified endowment contract to any tax professional, that is not a tax, that is not something they want to hear. That is going to be an incredibly big tax bill. Your money is able to grow without being taxed each year because of the IRS codes that we mentioned before. And the great thing about it, this does not create taxation of your Social Security benefits. So some people may be wondering if this will count against your Social Security benefits. Social Security, no. Disability, yes, but not Social Security. Now, let's go over some bad IUL advice. This is not a tax loophole. This is not a way to avoid taxes. This is totally legal. Understand? This is within this is within IRS standards. This is not free money. This is not a way to hide money. This is not an investment. I repeat, this is not an investment. This is an asset, ladies and gentlemen. You do not want to pick a fight with the IRS. The 20% of lawsuits that the IRS loses are from the mistakes that they make. But the remaining 80%, they're undefeated. Okay? You must follow the rules, work with licensed advisors and financial professionals like myself to keep your policy aligned with your goals. Now, so people may wonder, how do I structure this? Tailor it towards your goals, your age, your health, and your financial priorities. If you want more cash value, prioritize your retirement or savings, and you will choose a smaller death benefit. Or if you want more protection, then you will prioritize your death benefit to protect your family, your debts, and your other financial obligations. If you want cash value and protection, if you want to balance both of those, that is something you can absolutely do. And like I said, it's flexible. It can be adjusted over time. Okay. Now, what are the advantages of something like this? The insurance company assumes the risk in the event of a market downturn. Now, some people might be saying, whoa, 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 whoa. What do you mean? What do you mean by that? What I mean is because of the indexing strategy, if the market goes down and if it crashes, the insurance company does not get a hold of your money. Your money is protected. So regardless of how the market performs, the insurance company has to pay you money in your cash value. Okay? That's what they mean when they say the insurance company assumes the risk. Because regardless of how it works out, your cash value is going to increase depending on how well the market does, and your money is going to be protected. Okay? The funds are held in the insurance company's general account. These insurance companies make a lot of money. Okay. They make a lot of money. Greater upside potential, accurate return figures. Now, when they say accurate return figures, if I'm just being honest, the return figures are usually pretty conservative. But the reason why they are conservative is because we would rather do one of two things. We would rather under promise and over deliver. We will much rather exceed expectations than fail to meet those expectations. Okay. You cannot lose principal regardless of the fluctuations in the market. Remember, because of the indexing strategy, it's linked to the stock market, meaning it mirrors the stock market performance. It's not directly invested into the stock market. Okay. And it could come with a variety of options. Some come at an extra cost, some don't. You can choose from guarantees, riders, and some IULs even offer account bonuses. And what that means is that on day one of your contract, what the insurance company will do is they will give you what's called a welcome bonus, meaning they will put a percentage of money into your cash value day one of your contract just by simply working with this insurance company, just because of that. Now, let's go over more advantages. Annual reset provision. The name, all this means is in the name itself. Every year for your index strategy strategies, when the new year starts, you start fresh. Every resets and you start from square one, but your gains from the previous year are locked in. Okay. No minimum age or income requirement. You don't need to make a specific amount of money. You do not need to be a specific age. You can do this as a child head start plan, which I'll cover very shortly. There's no mandatory distribution, meaning there's no specific amount of money you have to take out each year, like an RMD. You can access it at any age, depending on when the policy was started, and it gets protection from lawsuits in many states and avoids probate. Now, divorce lawsuit can make it complicated because an IUL is considered an asset. That could definitely be considered an asset in a divorce lawsuit. So keep that in mind. Now, it's continued if the policy is disabled. There is a rider called waiver premium, meaning if you go to a licensed health practitioner or a doctor, and if the doctors let your insurance company know, it's like, hey, this gentleman or woman came in from an appointment. They are medically disabled. So what this means is because you are medically disabled, you do not have to no longer pay for your life insurance policy without it lapsing until while you are disabled. Now, what are some disadvantages to this? If this is designed incorrectly, this strategy can backfire badly, very badly. For those of you who watch NASCAR, or at least pay attention to NASCAR, there's a NASCAR driver by the name of Kyle Busch. Essentially, what happened was he ended up putting away about $10 million in IULs. And unfortunately, what happened was the insurance company and the agents that he worked with did not do a very good job of explaining to him how this actually works. So long story short, he ended up buying about $10 million in IULs. And in actuality, he ended up losing about $8 to $9 million. And now he is suing the insurance company, and rightfully so. So if you do not know what you're doing, this can absolutely backfire on you badly and cost you a lot of money. Okay. This is a long-term commitment. Okay. This is something that you're probably going to have to commit to for at least 10 to 15 years. Okay. You're going to have to be playing the long game. Okay. Early withdrawals can incur surrender charges, meaning if you try to take out too much money early, there's going to be a percentage of money that is going to be taken from your cash value when you try to take out too much money. Okay. A policy lapse can significantly affect your cash value, i.e., the Kyle Busch situation, and it can be expensive with high fees. So you have the riders, you have the administrative costs, and you have other expenses that can reduce your cash value. Okay. But I can explain how you can reduce those costs later on in this presentation. And the last one, it's not for everyone. Everyone is not going to qualify for an IUL. Some people may not be comfortable doing something like this, and that's okay. Maybe you're fine with just a term. Maybe you're fine with just whole life. Maybe you're fine with just standard universal. This is not for everyone, okay? There's nothing wrong with that. Now, as far as personal uses, there's a lot of versatility to an IUL. So let's go over the ways that you can use this. Basic death benefit protection or legacy building. Your estate can be significantly increased with the purchase of a life insurance product because this qualifies as an asset, but it also offers a guaranteed death benefit and access to your cash value accumulation. Okay, this could be a future tax increase hedge. Let's be honest here, ladies and gentlemen. The economy is in shambles right now for the United States. But the only way for us to get out of debt is if we increase taxes. Because let's be honest, the government is not going to stop spending money. Let's be honest here, ladies and gentlemen. So taxes are probably going to increase within the next 10 to 15 years. And this is something that you can use to combat that when taxes start to rise. And it can give you some flexibility. Okay. Because let's be honest, the more the taxes increase, the more your money is going to be taxed. So if taxes are increasing, and if you already have something like a 401k, and then you try to take your money out 10 to 15 years down the line, now you're going to end up losing more money because the more money you put into those retirement accounts, the more money you're going to potentially lose. Okay. Long-term care protection. If for those of you who work in the healthcare industry or do not know, long-term care is incredibly expensive. The average cost for a nursing home is about $100,000 a year in the United States. Okay. They have what's called accelerated benefit riders that can allow you to access part of the death benefit while you're still alive if you face a qualifying chronic or long-term care event, or you can use loans from your cash value. And something else that isn't listed here, there are certain IULs that have what's called a long-term care rider, meaning there is an a monthly IRS limit that you can use portions of your death benefit to help pay for your long-term care expenses, whether it's in a nursing home or an assisted care living facility. Okay. Then you have an inheritance max strategy, which protects your legacy from taxes, market volatility, and unexpected expenses. If people wonder why, well, how do the rich stay rich and how does the wealthy stay wealthy? This is one of the ways how. Is by doing exactly this. Now, some may be curious, well, what are the markets for an IUL? Who could use something like this? Somebody who wants tax-free retirement income. They get coverage during their young working years, and then over time, while they're working, they generate their cash surrender value. Somebody who wants to start a college fund or a child head start plan. The death benefit may be used to pay college tuition in the event of a parent's death, or you accumulate cash value over time to help supplement college tuition through policy loans. And another way that you can use this, if you use this as a child head start plan, and you do this on a child that's, let's say, 2 weeks old, okay, and if you fund that cash value over their 18 years, and you stop paying it, and then they graduate college, let's hope they get a really nice scholarship to a really nice quality university. They can use the portions of their cash value to potentially pay off their student loans because you let that cash value grow up for the past 18 years. You funded it, and even as they're in college, their money is still going to be growing, even if you stop funding it. Okay. Because typically within those 18 years, you funded it to the max amount. Okay. But most popular thing to use this for is a 1035 exchange. What the 1035 exchange is the internal revenue code to do one of three things: turn old life insurance into new life insurance, turn an old life insurance policy into an annuity, and an old annuity into a new annuity. You can use this method to dramatically improve your performance in building your cash value or your death benefit. Think of it as a tax-free exchange for life insurance policies. That's pretty much what it is. Now, you can also use this to maximize an annuity. Purchasing an IUL with an annuity fund can provide the most value for their loved ones without limitations of income or estate taxes. How this works is with an IUL, you want to overfund it as much as possible early. So if you take the funds from an annuity and if you overfund it in just one large lump sum payment, you've already paid the cost of insurance, you've already paid the administrative costs, and you've already paid off all the fees you need to pay off. Okay? You could use this as estate planning. This could be a suitable solution to help offset estate taxes, build an estate, and equalize your inheritances. And you can also use this as limited pay plans, more reliant on interest rates to maintain sufficient policy values than annual pay scenarios. You can use this as a business strategy. You can use it as a buy-sell agreement. If you have a business partner, let's say your business partner makes 500,000, you make 500,000. If one of your if that business partner, God forbid, something happens to him, now you have to replace your other $500,000 to help supplement the business. You can use this to generate cash value needed to help supplement the buyout of a business. You can use it as an executive bonus. Business will value non-cash bonuses provided for executives. You can use it as key person. It's death benefit protection that can help business owners shoulder the financial burden of a key employee. Every really great business owner with a staff has that one employee where if they were to lose this employee, their business is in trouble. They show up on time, they never complain, they don't take a sick day, the customers love them. That's what this is used for. Okay. You can use this as the defined benefit plan as a tax reduction or a retirement strategy. Now let's go over some options. This is a nationwide IUL 2020. This is for affluent, high net worth clients ages 40 to 70 looking for cost-effective second to die permanent life insurance. Second to die means if the death benefit is going to pay out when the second person dies. This insures two people at the exact same time. It is designed for couples and owners of family businesses with competitively priced death benefit and some potential cash value accumulation. Okay, we have the Ethos Accumulation IUL provided by North American. You have three solve options. Solve options meaning you can maximize your cash value, you can maximize your retirement income, or you could do a smart solve, which is like a balance solve. You prioritize both cash value and death benefit. Okay. As far as the underwriting goes, it is a 90 to 100% instant decision underwriting and 6 riders included at no cost. Okay. You with the Ethos Accumulation IUL, you can literally get your quote, go through underwriting 10 minutes or less. Okay. Then we have Corebridge Quality of Life Value Plus Protector 3, which is a death benefit focused for value seekers looking for lower prices and extended guarantee periods. It combines special features and crediting strategies to reduce the cost and deliver maximum value. So we got some great options here. Every IUL is different, and every IUL is designed for a specific type of person that is looking for specific things. IUL tips: maximize your cash value, you minimize your insurance costs. Remember, I said that you want to overfund this early, but you don't want to overfund it to the point where you're going past the MEC limit. Okay. Use index strategies wisely. Okay. You cannot go wrong with the S&P 500. Okay. You cannot go wrong with the S&P 500. I believe if I remember correctly, over the last about 40 plus years, the S&P 500 has averaged about 7 to 7.5%, which is pretty good. So you cannot go wrong with the S&P 500. Must know terms. Target premium is the ideal amount for funding this for long-term growth. This is the premium you want to use, or it's the premium that you want to pay to make your IOL reach its full potential. Okay. The minimum premium keeps your policy from lapsing. Then you have the single guideline premium, which is the one-time IRS approved max deposit, meaning this is the largest lump sum payment that you can make without making it a mech. Okay. Then you have the 7 pay test. This is the IRS rule capping total premium in the first 7 years. Okay. Then you have the cross it. This is when it becomes a mech, and that's where your loans become taxable. And once again, that is not something that we want. So an IUL, in short, you can draw income in your retirement tax free, receive market like returns without any market risk, never take a market loss or experience market recovery, access your money at any age depending on when this policy was started, continue making savings contributions if you become disabled, provide large income tax free lump sum payment to your family if you pass away, and you can remain protected against most lawsuits in most states. Okay. Now, the questions you want to ask yourself if you want to do something like this: what does retirement look like for you? Are you afraid of taxes going up or the market going down? Do you prefer guarantees, growth potential, or do you prefer both? Do you want to access your money before 59 and a half? Do you have a plan that gives you tax-free income? And the answer to that last question is probably a no. So thank you all so much for tuning in, ladies and gentlemen. Appreciate you watching. Please remember to like, share, subscribe. Really appreciate you. Really appreciate you guys supporting the channel. Channel link is in the description. If you want to, discuss with me, see what options we have. I am licensed in Maryland, Virginia, and Texas. Thank you all so much for tuning in. Until next time, everyone, have a wonderful day.